All right, welcome everyone. Thanks for coming out on a Sunday morning, cold as hell, but hopefully warm up. There is hot coffee and some hot water up front, so if you haven't grabbed that yet, do that. Pastries, please finish all those home so I don't have to bring it home myself, so eat up on that. So for the next 40 minutes here, we'll just take some time to go over some taxes, how you can save some money, and then we'll go hit the pickleball courts out there. So we'll get that going. I think we got 2 or 3 courts reserved. Danny, do we have 2 or 3 reserved? 2. All right, so we got 2 reserved, so we'll have to play and talk a lot on the side. So, but that's kind of the whole purpose of the event. Is overall just a cool way to network. The cliche saying that I thought was super cheesy back in the day was your net worth is your network, and I'm like, oh, this is very true. As you go through life, and it was just kind of reflecting on my dad too. He came over this country, didn't know a lick of English, still doesn't know that much to this day, but his network was very deep. So he was able to succeed pretty well. So really networking with other people, a lot of super smart, rich people here. So I'll probably say hi, some sleepers in this crowd. And then also we actually have our team offsite, and a few of my team members are here today. So Eldar, he's our COO here, asking for some tax questions along the way if you're networking there. Cole, he's our tax strategist too back there. So he's out here too. And then Mr. Ryan is somewhere here. Super tall dude. I think he's probably the tallest dude here. So if you see him, also he's one of our tax strategists. So feel free to steal all the tax advice from those guys. Cool. All right. So we got that rolling through the agenda, and then we'll just dive right in. I'll probably have a little bit of time for Q&A, so we'll see how that part goes. If not, the Q&A can just happen while we're playing pickleball. So you guys can just come up and ask any questions that you do want also. So I had a good question earlier. We had an S Corp started up. And then anything they need to do, and it's just we gotta get the balance sheet, income statement ready for the year. So just ask questions like that so you can get that ready for your taxes. So the first part I just want to start off with is just the importance of taxes and tax planning. Obviously it's one of your biggest expenses in life, and it's always going to drain anywhere from 20 to all the way up to probably 50% for some of us over here. It's just always going to happen. And I always tell folks hey, if you save $10,000 for 30 years, you'll have 1.3 million at an 8% rate reinvested. So if you save $10,000 every year, you put that away in the savings at 8% growth, you have 1.3 million. So all that's just free. So if you can find ways to save money on taxes, please do find a way. If not, you just can overpay and not have fun. So that's a big part on tax planning. Some plan is better than no plan. Also, I tell folks it's kind of hey, taking some steps is better than taking no steps. Working out a little bit is working better than not working out at all. Same thing goes for your taxes. So do some type of tax planning. It doesn't have to be anything extravagant, crazy. It can be as simple as just putting money into a Roth IRA or a 401k. That's super easy. So it's not limited to just the super rich people. It's available for everyone. So the big thing that I have here for today, I'm going to go over kind of 3 main areas. These are bigger umbrellas that I want you guys to think about. And then there's sub-strategies in all this here. And then that we can dive into it on this side there too. So the first one that I got here today for everyone, that's going to be useful for year end still, that you can still do, is just going to be donations. And then as there is in life, there's many levels to donations that you can do. So the first one obviously is you can just do your cash donations. And one big misconception on cash donations, they are not dollar for dollar donations. So some people are oh, I donated $1,000. Can I get $1,000 off my taxes? That's not the case. You get $1,000 off your adjusted gross income. So donations are only as strong as your tax bracket. So if you have that, that means, let's say you're at the highest tax bracket, which is, good old California, you're at the 50% bracket. So if you donate $1, you're going to get 50 cents on that. So there's going to be 50 cents that's going to save you on taxes, and then 50 cents out of the goodness of your heart for whatever organization that you give that to. So that's the first simple part. Now the next part that you can go and really level yourself up here is going to be, oh, my handwriting is really bad, appreciated assets. So the first level of this is good old stocks. So why do you want to donate stocks? So a lot of people that I talk to, they donate to the church a lot actually. So that's where I see the biggest area of donations. And if you want to donate stocks to your church, The main reason is that whatever you donate it at, that's the fair market value of what you get for a donation. So if you get a stock for $100 back in the day, and it's gone all the way up to $1,000, so anyone working at NVIDIA, that would be you. And from here, if you donate it, you get a $1,000 donation, even though you only paid $100 for it. So now you've eliminated the capital gain of $900, and you'll save, in good old California, you'll save, roughly about a third of that. So that'll save you about $300 from just donating appreciated assets. So you give it to a church, that's one area. A lot of people, Eric sets these up too, donor advised funds. So a donor advised fund, he knows a lot more than I do on this side, but essentially it's a way for you don't have control of the money, but you can advise on where the money's going to go for charities that work with it. So it's a great way to bunch a whole bunch of money into it and then allocate it that way. So donating stocks is huge for you for appreciated assets. This also works, at the next tier. So the next tier here where this can really go crazy would actually be, so we have appreciated assets, and this would be the next tier, I would say, I don't know what to call it. We'll just call it fee simple donations. So these are still some last minute strategies, like probably the only last minute strategy you can still do. So what this is, essentially, it's why do rich people buy art? So they buy art, say for $10, and once again, some fancy appraiser, this Picasso painting is now worth, say $1 million. All right, there's a third-party appraiser that says, hey, this is worth a ton of money, and then what they do is then they donate it, and then they get this off on their taxes. So they get $1 million charitable contribution that they bought for $10, but you don't find Picasso paintings every day. So how can you actually do this over and over? We got a vendor that helps us do this via land, via trees, where you can come in, pay $25,000 for the donation, you'll get about $100,000 back in charity, and then that way it can save you in taxes. So from a mathematical point, how does that work? So you put in $25K, and then that becomes $100,000 as a charitable contribution. Once again, we said hey, we're just gonna take Bob, who's super wealthy. I'll take Eric, since he's got a really nice car out there. He's at the 50% tax bracket. He's at the 50% tax bracket. So this means he has $50K in tax savings that he paid $25K for. So he's making or saving an additional $25,000 here. So this is how the rich get richer. It's kind of like, the more I do this job, I'm like, oh my gosh, it's rich do get richer. you realize, and which is which is fine. It's just, you just have to play the same game that they play. So like Donald Trump, he's got $600 million in this, high risk, high reward, but it's one way to still get money out of the tax code this way. So fee simple donations, it's a great way to save money and how you can control it. And then I kind of ran out of room, but I'm just gonna cheat and go one more. The last one on the donation part, before moving on to the second principle for the day, would be a private family foundation. So has anyone heard of the Bill and Melinda Gates Foundation before? Couple? Yeah, nice. All right, cool. So essentially you can have your own. So you can have a Fallen Law Foundation, and from here what you can do is that you can donate up to 30% of your adjusted gross income, and you can now control where that money goes and carry out the activities that you want it to do. So if you're super passionate about basket weaving, I'm not sure, whatever floats your boat, you can start carrying out activities towards that, and then you can hire family members to carry out those activities for you. So that's a great way to stash your money towards this way, and then also control it. So if you don't have a business, this is a great way to put money around. So donations is a big part for what you want to do, but there is one caveat for donations that a lot of people get confused on, is sometimes it doesn't help at all. Yeah.
So also another thing about donations, right?
The easiest thing to donate is your old stuff, right? So all the stuff will cost you money, but your old stuff doesn't cost you anything, you already paid for it. So these are things like clothes, electronics, books, furniture, so on and so forth. You already paid for it, you don't need it, give it to Goodwill, give it, get a receipt, and then boom, you will be able to deduct a donation. And then as Tony mentioned, the SALT cap did increase. So a lot of you didn't itemize because the SALT cap was only 10K. But I think going forward, you will comfortably itemize for at least the next 4 years. So definitely donate, because donations only help if you itemize.
Solid, that's good stuff right there. Good reminders. And then also starting in 2026, even if you don't itemize, you can get a magical $1,000 above the line deduction. So, 2K if you're married. Yeah, so more incentives to get married. So next year a little bit more. But on actually getting married, there's one dude that just came to me, and then he had a huge loss. It was like a $1.6 million loss, and he couldn't realize it because you only get the first $313,000 if you're single. So then he was kind of mad. I was just joking with him, like he could unlock double the amount if he got married. So you get $626,000, but he didn't respond to me yet, so we'll see. No, he just got divorced and got a girlfriend. And I was like, hey, dude, you want to marry her? Yeah. Really, I have really bad jokes, but it's cool. You got some clients still. There's Ryan here too. Ryan's on our team. He's one of our tax strategists also. So yeah, all our tax strategy folks are hanging around today with us, and you can just pick their brains for all the tax saving ideas there is too. All right. So the second one now. So we went through donations, and now this is the next one here. Is deductions. So deductions, these are still like last minute items this year that you can still do. And deductions, obviously, what is like a qualified deduction? It's ordinary and necessary for your business. So make sure they meet those two. Some people are like, oh, do you have a whole list? And I mean, we kind of do, but it's like not applicable towards everyone. It's like whatever your business is, then you can be able to write it off as long as it's ordinary and necessary. So you just want to be aware of that, have the rule first. And then in terms of deductions that are going to be good for still year end is, I would say things that you can kind of prepay. So say, for example, like you want to go Hawaii next year, you're ready in like Q1, might as well just book that vacation now, get the deduction, or not vacation, sorry. It is a business expense. That's too, I was like, whoa, that's, we're on camera here. I'm like, oh shit. What we got, that is a business write-off to visit the rental property is not in shambles. Yeah, and then afterwards, you can go get some food after working really hard. So prepay for all the expenses that you know you're gonna use next year. One funny story was my little sister, she's an artist, and then she asked me like 3 nights ago, I was like, hey, like, should I buy inventory now or January? I don't get the difference. And I tried texting it to her. I'm like, yes, you get the deduction when you spend the money. And she's like, I don't get it. Oh, this one's a unique one. Oh, loopholes. Yeah. Oh, I got loopholes for you guys. Yeah, and then she didn't get it, so I was like, oh my God, let me just call her. And then I was just like, all right, because you are a cash basis taxpayer, which essentially means like when the money goes out, you get the deduction. But you would think, hey, inventory, I didn't actually use or consume it yet, I can't write it off. So that's what's going on in her mind, and then some of our minds too. But there's a loophole that says like if you're under $25 million for the last 3 years, and she's not to the state yet, so otherwise I'd ask for money, she can actually write off her inventory. So I told her like, hey, because she made this junk journaling bag, and then so where you can store all your junk journal materials. And then I was like, hey, if you spend $20,000 in inventory now, in December, and assuming you're at 25% tax bracket, that'd save you $7,500, or $30,000 in inventory, save you $7,500 in taxes. Versus buying in January, it'd be too late, you don't get the deduction for this year in 2025. So if you're like an inventory-based business, this is great if you're under $25 million here. So using your deductions ahead of time right now is really big.
And then again, like prepaying for deductions ahead of time doesn't really have to cost you money. You can finance this stuff. You can open up an interest-free credit card or get a bank loan or a HELOC or some kind of financing. So you're essentially paying very little money now to get massive savings for 2025, right? If you buy a car December 30th for business and you finance it, guess what? Full write-off for 2025.
Oh yeah, that's actually pretty good. Danny taught me that trick actually back in the day where you get the 12 months interest-free credit card. But I was like Mr. No leverage back in the day, no credit. I was like, I got to pay off all my credit cards. And I'm like, oh, good point. You get more, it's free money technically. So I think once you kind of get over that hump, because my dad back in the day, he taught me, he was like, bro, if you don't got cash, don't buy it. I'm like, okay, sounds good. So that bad habit really is not good. So understand leverage, it's very important. So deductions, the second one is income shifting. So this one you can still do in the year end before it's too late. And essentially what this is, does anyone support their mom, dad, brother, sister here?
My dog.
One dog. Okay, couple? Yeah, Yeah, so if you support them, just make them work for you. Make them a business write-off. So the big part is, had one dude, he was helping his mom like $3,500 a month. And I was just like, hey, she could probably just do a lot of administrative work for you and become a tax write-off. Versus just giving her $3,500, it's not gonna help him. So, this times what's 14. So let's save him 1.4K in taxes. He's over in New Jersey. And so just because he's making his mom a tax deduction for him, obviously they actually have to work and do something, but there's a lot of back office stuff that people can do these days online that can help. So if you're helping any broke brothers, sisters, mom, dads, you're supporting them. I know, a lot of people support their parents. Make them a business write-off, because usually they're in a way lower bracket. But the main part you got to watch out on this though is if they're on like Medicare or food stamps, like don't mess that up. So they're gonna come after you and be like, oh, I lost my Medicare because of you, and then that won't be a good Christmas party for you. So income shifting is really big. For kids, this is always the go-to. So the standard deduction this year is $15,750. So you can pay your child $15,750 all income tax free to them if you would like. Obviously, you have to earn it to make it like real, but there's baby models are making reels these days. So income shifting is big, and then the other two is just like if you just have like a broke friend, you can just have them help you out, shift some money towards that way, and then you split the income tax difference. So I would say, hey, don't look at it as just yourself as a taxpayer. You want to look at it as a whole team, a whole tribe to win against the government, because 3 people's tax brackets combined versus 1 at the same time, this one will always, you get more efficiencies. Unless everyone's super rich, then it doesn't work. But usually you don't have that many rich friends, or I just need friends maybe. So income shifting, deductions, 1, 2, there was a third one that was in my mind. Just slipped me. Oh, you got one? Oh, nice.
So income shifting does require documentation, right? If I hire somebody off the street and I give him cash, it's not a deduction. I need to do one of 2 things. Number 1, issue a W-2. W-2 do cost money. You got to run payroll. Deadline is 12/31. Kind of expensive, kind of stringent. 1099s are cheaper, and the deadline is January 31st. So even if you pay somebody, you don't want to go through the hassle of giving them W-2, you can give them a 1099 in January. It'll be much cheaper, much quicker, much easier.
All right, now I have remembered my third point that I want to make. Is the third one would just be, everyone here, hopefully you have a roof over your head. So either you can use the home office or the Augusta rule if you have a business or even a rental property, if you actually have a real dedicated space. So these are expenses you can still squeeze in before year end. So how it would work is that if you have a home office, or you can use the Augusta, whichever is the higher of the 2. Augusta is obviously if you own your home. If you don't and you're renting, you just use the home office. So you can take, roughly around 20% of your total expenses of what you pay for rent, insurance, utilities, and reimburse yourself for a home office as long as you have a dedicated space. So it can't be a personal use space. The main part is where people get in hot trouble. It's like, hey, I use my bedroom for my home office, and you want to take the whole thing, but you sleep there too. You probably it won't work as well. So you want like a dedicated space towards this. Some people try to be like, oh, like 700 of the 800 square foot of my apartment I use completely for content. I can write it all off. I'm like, nah, you also use the bathroom, you also use the kitchen, you can't use that. Plus the IRS also wants to see like roughly about 20% max on the home office. So home office, it's free money you're using already that you're paying every month. And then the Augusta rule, for folks that don't know what the Augusta rule is, this is essentially where you can rent your home to your business 14 days tax free. So I actually had these gentlemen over in the summer, and you guys were 5 days, I think? Yeah. So then the business is going to pay me personally for those days, and then I'll get a write-off on the business, and then I'll pick that income up tax-free and still get a tax deduction. So is this using what you have, like Eldar said, like, hey, you got assets or like items laying around the home that you can donate? So yeah, they also want to say, well, I should clean up my garage and donate a lot of stuff. So we'll work on that.
And then the Augusta rule applies per primary home, right? The rule, if you rent out someone's primary home for 14 days or less, they pick up no taxable income. So if you have friends, family, relatives with primary homes and you want to use their home for business, you can rent it out under 14 days, tax-free for them. And if they like you enough, they might gift you this money back.
Good. And then the nice thing too is just like it's fair market value of your property. So, Alice, I know you got a nice place, so you can yours will probably be super high for 8 hours to rent that spot out. So it's take it fair market value. We just say, hey, you can just check out different sites or like compared to you rent out like movie theaters. So there's different ways to determine fair market value of how you can rent out your home to your business. So those are deductions, and then the last one here that I got for everyone before I hop into the Q&A. Mother Nature, getting windy. All right, is going to be deferral right here. All right, so deferral is actually one of the biggest things because when you add it, well, I'll say that at the end actually. So deferral is one of the biggest ways to save on taxes, right? The main part is you have to have delayed gratification. So you can't take the benefit today, you'll just push it and kick the can down the road. So the first part for deferral that you can do, and there's many ways. The first one I would say is this your retirement accounts. So technically many retirement accounts, you're deferring when you're going to pay taxes on it or you take the tax hit today. But the main one for your retirement is going to be your 401k. So this is the employee portion of it and then the employer match of it. So you have employee, EE, and you have employer portion of it. So the main, kind of just use an example here, is we had one client, he made a lot of money this year. And I was like, dude, you got anything to do with it? He's like, no, not really. So I'm like, all right, we'll just do a solo 401k. So we did a solo 401k. And what we did was his employee was 23.5 grand. And then you can go all the way up to $70,000 combined. So then we did 46.5k here. This guy's over in Newark, here local. And because he's at the highest tax bracket, he's gonna save 50%, so he's going to save 35 grand on taxes by just putting money into his retirement account. So first he did 23.5k as the employee part, then his company matched him 25%, the max 46.5. So he put $70,000 into it, and then he'll save 35,000. So technically the government's like almost, if you want to say it, matching him 50% or matching him to whatever the effective tax rate is.
Deferring him.
Yeah, deferring him. Yeah, so when he's at 59.5, it's going to be a bigger problem then, but until then.
Roth conversions.
Oh, Roth conversions. Oh, nice. Yeah, and then the other part too, like Eldar just mentioned here. You want to do that one? Sure. Nice.
So like deferrals, you kick the can down the road, right? So essentially right here, we're kicking about $35,000 of tax down the road. This is assuming we stay in top bracket, but as we get older, our income might decrease, our state residency might change as well. So for example, let's say when he is 60, he stops working, income goes down to 0, and he wants to begin efficiently taking out the 401k in a lower bracket. A smart thing to do would be to temporarily move to a tax-free state, do some other strategies, and little by little convert this money into a Roth. That way, you deferred in your higher taxed years, and when you're older, you're converting in your lower taxed years at almost a 0% rate. So essentially, this deferral may become a permanent tax saving.
What's your favorite state to get out?
Oh, Florida, of course. Florida. No, we got a solid 7-8 months of beautiful weather. Yeah.
Eller lives there, so you might be biased, but it's fine. Oh, name tag. All right, so Roth, and then actually speaking of Roth, which is a good part, is if anyone wants to do a backdoor Roth right now, you have to do this before year end. So you can do a normal Roth IRA contribution next year, but you can't do a backdoor Roth in next year for this year. So if you want to do a backdoor Roth IRA, it has to be done by 12/31/25. I do know, I think our legend has it, I think Fidelity is really slow on doing this. So you want to start that process ASAP if you want to do that. The one big part that will get you though is if you have money in your traditional IRA right now, you're going to have to pay some taxes on it. So just be mindful, but this is actually one of the more sensitive things before year end. And then the same thing with this portion. This needs to be done before year end. The cool part though, if you have a business, is that you can actually extend your return and you'll get 6 months extra to contribute towards the employer side. So that gives you 9 months or 6 extra months to earn $46,500 in 2026 for your 25 contributions. So this is way that you just keep on just timing the differences with the tax code in order to take advantage of it. So deferrals, retirement, strong way. And then for those like super savers out there, this is more business related once again, but this would be a cash balance plan. Cash balance plan. And essentially what this is that say you're like, hey, I did $70,000 check and I still have an extra $50,000 that I don't know what to do with it. You can start up your own cash balance plan and hypercharge your retirement, and it defers it. So you can put another $50K towards your retirement, and then once again, you'll take it out when you're 59.5 and pay taxes then. So cash balance plans, usually very high consistent income earners, doctors, lawyers are like the go-to that use the cash balance plan. So that's deferral. Number 2 on the deferral list, you got retirement. Oh, okay, next one is opportunity zones. So what is an opportunity zone? An opportunity zone, the first part is you need an opportunity fund. So an opportunity fund essentially is a partnership that allows you to defer your capital gains from stocks or real estate. So usually you can't really defer capital gains from stocks, and opportunity funds allow you to do this. So you have a fund that'll hold the money, and then from there you have 180 days to buy into an opportunity zone. What is an opportunity zone, you may ask? An opportunity zone are areas where the government wants you to reinvest and put money back into. For lack of better words, probably the hood. So that's where opportunity zones are, because they want to spur economic development.
Or the boonies.
Or the boonies, yeah. But then also like anywhere in the Bay Area is not that bad. So yeah.
You should move to Florida.
Florida, okay. Yeah, no state income tax.
No credits.
Yeah, so opportunity zones. So if you have a lot of capital gains and you want to defer it, putting it into an opportunity zone is good from stocks. And then also if you have property that you sold that you don't want 1031 right away because of the 45-day identification window, opportunity zones are good too. So mainly, the main way I've used this recently was these guys sold a crap load of stock, didn't find us until that happened. And I'm like, all right, what can we do? So what we're actually gonna do is take an opportunity fund, put the money into it, defer the taxes till next year, make it fail on purpose. We're gonna try to look for something, but we're just gonna make it fail on purpose. And then now we've kicked the can. So like he triggered the gains 10 days ago, yeah, December. So then we're gonna kick that can down the road till, what's that, +5, May of 26. It's gonna fail. So then he has all the way until April of 27 to pay those taxes. So that's a lot of time to start figuring out what to do for that. So opportunity zones, there's strategic ways to use it outside of just the normal reinvestment. Because some people are like, yeah, I don't want to buy those properties. I'm like, all right, there's different uses for it. So opportunity zones are great. And then lastly, number 3 is just going to be the good old 1031 exchange for deferral strategies. This one, the same thing with tax planning here today. Like I don't expect anyone to remember anything besides my employees. But all these are just like tools in the toolbox for you to realize. And then like, hey, it sounds something like that. It sounds like me. Just so it like puts in your brain like, oh, okay, I think we should like talk about it, or like you can reach out, Google it, find it, reach out. So 1031 exchanges is like, hey, if you're going to sell a property, you're going to pay back a lot, right? First, you're going to pay the gain on the sale. And then number 2 is you're going to pay depreciation recapture. So a 1031 exchange allows you to avoid both of these parts. So first you have the gain that you're gonna defer, kick down the road, but then depreciation recapture. Most people are always spooked about depreciation recapture, and what this is essentially is that the government gave you a benefit today, and then you have to pay it back later when you sell. So it's not the end of the world. Like, people make depreciation recapture sound horrendous. It's not that bad. It's actually, you can, if you're smart about it, you can actually arbitrage it.
It's also
So,
capped.
yeah.
100%.
Yeah, so this is only 25. The max you actually pay is 25%. So say if you're in a high income year, you buy like an Airbnb at the 37%, and you want to do a short-term rental loophole, you can actually arbitrage 12% when you sell it back. So depreciation recapture can actually be used as a tool if you're in a higher income tax bracket that year. So 1031 exchange, if I add up the gain and depreciation recapture, say that's $50,000 in tax liability, that gives you, assuming 20% down, it gives you 5x more buying power. So by using a 1031 exchange, a $50,000 tax liability actually means $250,000 in leverage that you can take. So then from here, you kick the can down the road, and then you don't have to pay that right away. And then through all this, or these two at least, the nice thing about deferral, well, kind of nice, not that nice, but however you see it, half glass full or half glass empty, is when you do die, because nothing's guaranteed but death and taxes, is that all this that you deferred is now gone. So that means your kids essentially will pick up all this property that you kept on exchanging, and then they will be very rich, and we wish we were them. But it's, we live for a better generation. So that's the nice part about the 1031 exchanges, is how generation wealth can be built, is like you kick it, and then unfortunately when you pass, your kids are gonna pick it all up at zero capital gains. So
they can sell it tax-free.
Yeah, they can sell tax-free the next day. Yeah, or almost, or maybe even take a loss break. So that's going to be deferral portion here. So just kind of recapping here for everyone is that, big part is some planning is better than no planning, just like some workouts better than no workout. You shouldn't file your taxes, just like I don't build a house without blueprint. You have some tax plan. And then the three umbrellas here that you can really help on your taxes is donations, deferrals, deductions. Those are three main umbrellas with many sub things within inside of it. And yeah, hopefully you save some money on taxes this year. If not, the other part too is like, yeah, the year's late, it's kind of like, don't give up though. Like, it's just start. Like, when people it's like, oh, I don't want to save money, I'll just live my best life every day and be broke. It's like, dude, like, you gotta start at some point in time. So same thing with tax planning. You gotta start at some point in time. Yes, do you have to get there to make more money? Yes. But hey, if there's that portion, then it's just like, hey, have other conversations with other folks like, how can I make more money? So that's everything I got here. Any questions I can help with anyone? I guess it's up, dude.
Nice.
So it is the season of giving, right? We got the holidays coming up. So one thing that that is new in the One Big Beautiful Bill that both parties were on board with is something called the Trump accounts. So for those that are expecting or have friends that are expecting, I got some good news for you. Anyone born between 1/1/25 and 12/31/28 will get $1,000 from the government automatically. And then anyone can contribute into this. So friends, family, employers, they can all contribute into it. So anyone can put in $5,000 per year. So, if your friend just had a baby and you're like, oh, I want to help them prepare for college or the future or whatever, boom, you can give them up to $5K. And then for those of the W-2 jobs, tell your employer, hey, I want you to put 2.5K per year into my kid's Trump account. So out of this 5K, 2.5K can come from your employer. So definitely make them pay. And for the kids' birthday parties, tell them, hey, throw them in the Trump account. This is essentially an IRA. So when the kids go to college, they can pull this money out. It'll be cap gains. After 30, if they pull it out, they can use it for anything they want, buying a house, starting a business, but it will be ordinary income. But at least they're gonna have a pretty good piggy bank once they turn 18 to either pay for school, buy a home, or start a business.
All right, thank you. Actually, I think I saw some update. I'll double check on the year. Yeah, it depends on the year.
No, it's 1/1.
Is it 26 or 25?
I checked it now. It's 25. It's
Oh.
retroactive, but they're not gonna set up these accounts until June or July. So government, this is what they do. They pass laws and then decide how to implement them later. So they're still figuring out how to actually implement the Trump accounts. But they're thinking June or July.
All right, sounds good. Robin Fong, well, I got one comment here on the suits. I think that's gonna be our first client that has a Trump account, actually. Woo! Yeah, there we go. So I'm excited. So I'll claim that in their 27 taxes then. Yeah, we got some time to figure it out. So that's everything there. And then, yeah, any questions from anyone that we can answer? If not, we got 2 hours to be on the pickleball court and hang out also.
Is that 2.5K tax deferred as well?
So it's essentially an IRA, right? So like
Once the kids are 18, they can use this. If they use it for college, cap gains. So if there's like 50K in the account and they pull it all out, they'll pay cap gains, which is 0 for them, assuming they have no other income. After 30, they can use it for whatever they want. At that point, it's ordinary income.
I have a question. It's back to the donations thing way in the beginning. What's the tax difference of like donating to a nonprofit versus like giving them money and they advertise your name like, hey, they donated, they gave us money. You know what I mean?
Are they they're still non-charitable, right?
They're 401. They're like
501c3?
Yeah, 501c. That's what it is.
Yeah. Oh, both are good. Yeah.
Okay. Is there a tax difference between like donating and?
As long as it's a qualified 501c3, you'll get the donation and deduction.
So that's a good point. Charities often do that, right? Like you give them money and they'll throw your name on a billboard or an event. It's very, very common. ChatGPT said that can't be a charitable donation. It has to be like an advertising expense. That's why I was wondering if there's a difference. No. As long as it's a donation to a 501c3 and you give it to them, and they decide to use that money to advertise you, it's up to them. It's not up to you.
Okay.
Yeah, but then for your own like categorization, the nature of it, if it goes to a 501c3, you want to call it a donation that you'll pick up on your QuickBooks. Yeah.
Okay.
Yeah. So, but like regardless, you'll get it reduced from your
Don't
taxable
call it
income.
an advertisement, call it a sponsorship.
Sponsorship. Okay.
Yeah.
Cool.
Nice.
Thank you.
Devs. Yes.
Can you say a bit more about the income shifting part?
Oh yeah.
Yeah, right. Like we basically need to have it on payroll, and also do they have to be in the US?
Oh yeah, no, that's a good one. So income shifting, going back to here. Yeah, so income shifting, yeah, it can happen domestically, overseas. It doesn't matter where they're at. So as long as they're just doing some type of service for you, you're fine. So the income shifting anywhere. The thing from a paperwork perspective and how you actually do on payroll is, so if they're foreign, you just need to collect this form called the W-8 Ben. This is nothing that you file, it's for the records for you, just in case there's any backup withholding you have to do. So that's for foreign on that side. And then for domestic, if they are a contractor, you just have to issue them a 1099, make sure you get a W-9, and then they'll have to pay self-employment taxes if that's the case. But then if they're going to become an employee of yours, you can just put them on as W-2, and then you'll be liable for the Social Security and Medicare tax portion of it. So that's how the order of or the sequencing of how this works for the type of income shifting you do. And then as long as it's like a good rate for something that's reasonable, you can definitely write that portion off. And then you can use this through, the easiest ways, obviously your business, through real estate, or like, Danny's got his 2 kids, making them rake leaves, they could do that. So put them to work. Yeah.
So
Yes.
you say that the W-2 is more expensive than doing the 1099 for us, but for the person who is having that shifting, is this more tax that they have to pay?
Oh, theirs all the same. Well, that's actually less, yeah, because you're paying part of the Social Security and Medicare taxes.
No, that's for W-2, right?
Yep.
So you're saying like if I have a business, I do 1099 for those employees, but those employees actually have to pay more tax because of the 1099, or are they the same? You understand what I want to know? At the end of the result, which one is better?
So we're in California, right? California is really, really restrictive. They pretty much don't allow contractors. If you hire an employee and you treat him as a contractor and they sue you, they will win. But if they're okay with being a 1099, then it's better for you. Why? Because you don't have to pay their payroll taxes. You're giving them this entire income. This entire income for them is business income. It's not employment income. They're essentially a business. They have their own write-offs, home office, meals, travel, cell phones. So they're able to use a lot of write-offs to shave off this income quite a bit. But if they got a W-2, they have no options. But once again, just make sure that this is okay with the people that you hire.
So if you hire your kids, so still a 1099 is better than a W-2?
It depends on if you want them to. So kids don't pay payroll taxes if you structure it correctly. If it's structured correctly, they have no payroll tax. They're only going to pay, what do they call it, workers' comp? Yeah, workers' comp insurance. If you want them to have Roth accounts, we would recommend the W-2. If no Roth accounts, 1099 is okay.
So for example, if my kid is 21 years old, so she may already earn like $7,000, right? But your bracket right now is 15, so I can also hire her for another $7,000 in a way.
So people above 21 are not children. You stop being a child at 18. So you'll be paying an adult.
Okay, so then, I mean, so you can still do that strategy, right?
Yeah, for sure, for sure. And I mean, you can kind of game it, right? So you can give her a 1099, have her write off some income, and have her kind of maintain like a lower bracket.
Yeah, if you're like the 37, and then like if you're like in the 37 and she's like at the 12, you can probably push her to 22. And then you bring yourself
I
down.
see.
So that's where I say
Still push
you want
that
3
up.
people in 22 versus 1 person in 37, one solo. So you want to like collectively use the whole family as a taxpayer group. It's like a war against the government.
It's a team game. Wealth
Yeah.
building is a team game.
Yeah, Rebecca?
I guess following on that, so like my kids, they're over 21 and they have W-2 jobs. They did help clean out one of my rental properties. So if I'm paying them, I would, to do this, I would issue them 1099s.
I would do 1089 for rentals. Makes life a lot easier because the main downfall of payroll is you have to set up payroll, and payroll is expensive. So you're like $60 a month at least. Yeah.
On that, do I have to like change do I have to like start like an S corp or something, or an LLC, or because I just file my individual?
Yeah, you can just do it as a sole proprietor.
Okay.
Yeah, you don't need a entity, a LLC, or an S corp or anything. Yeah, entities generally 9 times out of 10. Well, LLCs, they only provide legal protection. It's the same tax answer if you have an LLC or sole proprietor, regardless.
So if
Yes.
you have an S corp, do you necessarily have to issue a W-2 for like your cleaner, for you have an Airbnb? Do you have to issue those W-2, or can you choose to use a 1099?
So it really depends. If you hire a company and they're like an actual company, they're an S corp, they don't really need anything. You would just pay them and that's it. If you're hiring individual contractors, it depends on how they are structured. So you kind of have to ask them like, hey, are you an S corp? Are you an LLC? Are you a sole prop? They're probably not gonna know. So just, to be safe, collect their W-9, give them a 1099, and then that's it.
So if they a DBA, then what does it like? They just what does it
Any entity can have a DBA. S corp, C corp, partnerships, LLCs, sole props, anyone can have a DBA.
So for W-2 earners, I heard opportunity fund is probably the best option. So kind of like stock gains, something like that.
If you're trying to, for W-2 earners, if you're trying to specifically mitigate capital gains, the opportunity fund is good for you to do. But like if you're just talking about like general tax strategy, there's a lot more you can do. Yeah, that's a little bit better. Yeah.
Because like for example, like sign-on bonuses, they'll typically take off like 40%.
Oh yeah.
Straight.
Yeah, so if you have a high W-2 year, you want to think about like what other things, like the charity part, solar investment tax credits, those are very good. Airbnbs, they're good too. Or starting up some type of business is like good too. All right, any other questions? Oh, yes.
I don't think the home office rule or augusta rule is relevant if you have a C corp as a business, not an LLC. Is that correct?
Oh, you can use them all, yeah. So you can do the Augusta if you have LLC. You can even do it like a
Multi-member are feeling.
multi.
Multi-member, S corp, or C corp. It has to be a separate filing
Yeah,
entity.
it is separate.
SC or partial.
Oh yeah. Oh, you just take home office if you're single member. Yeah.
Wait, what was the last part about that?
Oh, so if you have a single member LLC or sole prop, you just take home office, not Augusta.
Okay.
Yeah.
So you can still do the home office if you have a single member LLC.
Yeah.
Yeah. The only thing on home office for single member LLCs is that you can't go negative. So if you're negative, it just banks into the next year. So you can't go negative with a single member LLC for home office deductions.
I have a small e-commerce business, and last year I decided to create an LLC, but at the time I wasn't aware of like some of the regular yearly costs that come up for it. Like apparently there's an $800 fee from the government. I'm not sure if I missed something and there's like a way to like write off as many things as a sole proprietor, or does that LLC status really give me more write-off?
So LLC is purely legal protection. There's no difference. So prop LLC, you file the same exact way.
Yeah, you might want to file a final return just to get rid of it, because any LLC in California is legal without every return.
Until you close it down.
So yeah, if you're not going to use it for like an S corp, I'd probably just get rid of it. Unless you like the legal protection. It's hard to put a dollar amount on.
Peace of mind at night. Yeah. Yes.
So for the Augusta law, is it only applicable if you're the homeowner and the business owner, or can you? Because my brother has a business, and he's looking for ways to reduce his taxes, and he uses my place to do office.
Oh yeah. That's what Eldar mentioned too. That he actually taught me that. The multi Augusta, because I was like a 1-to-1. He's like, oh man, you got to like do the sister's place, you got to do the mom's place. I'm like, oh dang, a lot of business meetings, but I mean it's fine. There's meetings every day.
But like, it won't bleed into my income tax, right? It's 14 days or less.
As long as 14, yeah, exactly, 14 days or less.
Okay, and then my second question is, I'm considered like a high earner. So is it easy to start the private family, like, or is that going way like out of scope?
Oh no, I mean you can totally start a private family foundation. It's usually it's reserved for more affluent folks because the administrative fees are really high each year. Like you're probably looking like $10K, just in terms of like getting your 990, your bookkeeping, your payroll set up. So like your tax benefit has to be more than $10K a year. But I mean, say you put $50,000 in it, you're at the 50% tax bracket. That's $25,000 in tax savings, and then so you're up 15 grand. Also, the other part about private family foundation is you have to donate 5% of the asset value each year to whatever organization of the choice. So like you just use the funds from, because you can't self-deal in private family foundations. So I mean, you just use the foundation's money to pay for its compliance. Yeah, circular. Yeah. Great. Okay, I think Danny, do we got what pickleball courts do we have rented out? One. All right, so we got pickleball courts rented 1 and 2. So I think we'll got your question here. We'll hear soon, Rebecca, and then if you want to just use that, so milk out all the time there. We got 2 hours, so we'll probably just rotate, have some fun, network with folks, ask any of us tax advisors for questions too. We got Eldar in the blue hat, Ryan in the red hat. Cole has 2 hats, but none of them are on. But these 3 are my tax strategists on my team. And then we'll take one more question here.
On the 1031 exchange on the gains, is that so that's my selling price minus my cost basis in my tax returns? Am I allowed to subtract out like real estate commissions and like say if the buyer said, well, I want $10,000 credit with the closing? Is that how the gain is determined?
Oh yeah, the gain. Yeah, so if you want to do a 1031 exchange and try and determine the gain, it's always your sales price minus your adjusted cost basis. So what your adjusted cost basis means is that it's your purchase price minus the depreciation that you already took, right? Because that's going to reduce what your cost basis is. And then you're going to add back commissions, any renovations that you did, because those are expenses you incurred to sell the property. So it's going to reduce your gain. And then, if you have seller credit or concessions you need to make for the property to get it sold, then those are going to reduce your taxable gain again. So after all the math is said and done, it's like, do I even want to do a 1031 exchange or not? Because like they're going to cost you probably like $1,000 to $2,000 just for a normal one, and then you have that tight window versus when you can just do a lazy 1031 exchange instead, which is, it's not a technical term, it's just I sold a property, I bought another property and then depreciated it. So there's many ways to like plan for it to see if it's worth that headache. Cool. All right. Sounds good. Well, thanks everyone for freezing out here, listening to something. And if there's still food, please eat it all. I don't want to bring it back home. And coffee and drinks up there. And then, yeah, we'll see you guys on the courts. Thank you.